Advanced Financial Accounting. In this presentation, we're going to work a practice problem in Excel, which will be a consolidation problem where we will have two companies. We're going to consolidate together using a consolidation worksheet. We're going to have company P has purchased 100% of company S, and they did so not this year, but in the prior year. That's what's going to be different than a prior presentation. We're going to say this is basically year 2. Now, we also note that we're using the cost method. So that means that P, the parent company, is recording the investment in S before consolidation, not using the equity method, but carrying at cost. So that's going to affect the elimination entries that we will use. Remember that we are going to be taking up step by step and making changes in these consolidation processes. In this case, of course, P purchased 100%, not just a controlling interest, not just 51% or above, but 100% of S purchased at the net asset value. That's what it was purchased for, and they are carrying the investment in S at cost rather than using the equity method. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We have our information on the left. We're going to enter that information into the blue area in the right in terms of the journal entry as well as in our consolidation worksheet. So let's see what our information says on the left. P acquires 100% of S. So P is going to be a parent company acquiring 100% of the outstanding common stock of S company. So they're going to combine the whole thing out, all of it, not just a controlling interest, but 100%. And not only that, but they did so for $302,000, which happened to be the same amount as the net asset value, basically the equity value, basically the value of the company on a book basis of the $302,000. Then S common stock at the point of sale, we're going to say that S had $69,000 at the point of sale and a par value of $2. P decides to carry S investments at cost because the investment will be consolidated. So P's saying, hey, look, normally on P's books, you would carry this thing at the equity method because you have a controlling interest or you're right. But at this point, they're saying, hey, look, I'm just going to put it on books at cost because I'm going to do a consolidation worksheet anyways and represent as consolidated as well. So that's going to be the choice that they make here. The accumulated depreciation at the point of consolidation for S was $12,000, and the purchase at the beginning of the prior year. So this is the second year. So it wasn't purchased this year, but there's 2 full years that took place. The prior year, and then now this is the second year since this happened. This consolidation happened. All right. So then if we think about our transactions over here, we can say, all right. Now we're going to say, hey, P and S, give us your trial balances, just like we've seen in prior presentations, and we're going to put them into our consolidation worksheet. And once again, we might have to do a lot more finagling in real life to make sure that the accounts line up so that we can match up to the proper account with the proper account so they're grouped together properly in our consolidation worksheet. They line up pretty well here as if they had 2 chart of accounts that were very similar, which is what you really want to be going for when you have these consolidation type of processes. And then we're going to be summing up the total over here to get our total trial balance for the 2 companies, P and S. Then we'll talk about our consolidation entries. So now that we have this all set up, and this would be the kind of the difficult part to actually just put this information, just data input this into the system and match them all up. That takes, even with a good computer system, probably some manual work. And if you have a good computer system, it took a lot of manual work to set up the good computer system probably because you have to somehow match these things up. So now let's go ahead and sum these up. We're going to say equals the sum of these items. So we're summing these up. Then we're going to sum them down using the autofill. So we're going to put our cursor on the sum handle here and just autofill, or the autofill handle, and fill that down. So that's going to be then our consolidated trial balance. Now, of course, we're going to go into here and say, all right, well, which things have to be eliminated? Now, note this is the second year of operation. So if we think about, all right, what is P doing to record the investment in S? Well, we know when they originally recorded the investment in S, they just simply recorded the investment for what they paid, the $302,000. So the $302,000 is what was paid, and that happened to be the equity investment or the equity accounts, that the book value in essence of S at that point in time. So P just said, hey, I put it on the books at the $302,000 at the point of purchase. And then what happens when P records dividends? What else could happen? Well, S could record dividends. So now S records dividends. The dividends are going to P. So that's the other thing that can happen. What happens when a dividend goes out from S that is wholly owned by P? Well, P records a debit to cash eventually. Cash goes up, and then they're just going to record dividend income. So P's just got dividend income in cash. So that dividend is going to be something that needs to be eliminated. Note what P is not doing. They're not recording on an equity method, as we've seen in prior presentations, using an equity method, the value of the investment as it goes up. So 70,000 income here. On an equity method, we might reflect that, and we should reflect that under an equity method in the investment. But P decided not to do that. P's saying, hey, look, I'm just gonna carry it at cost, and then I'll do a consolidated financial statement. You can see it all consolidated together. So it's on the books then at cost at this point in time. We also didn't adjust it to the market value. So you'll remember that if you were under 20% ownership, so if P owned under 20%, you would do a similar method that P is using, but then they would adjust the investment in S based on the market. At the end, they look at the statement at the end of the year and adjust their investment. They're not doing that part. So they're doing everything except that. They're just carrying it at cost. We're just going to carry the thing at cost. We're not going to adjust it. We're going to consolidate, and that will adjust. That'll show the consolidation process. All right. So then, what's that going to look like? If we then do this, we're going to say, let's do our elimination entries. We got to get rid of the investment here. We know that, and we definitely got to get rid of the dividend income that is coming from S. So this dividend income, the dividends here, and the dividend income there. So we know those need to be eliminated. So I'm going to go, all right, well, I know that much I know. So we're going to have to say that we've got the investment is going to have to be removed, and the investment is going to be, I'm going to put it on a credit. And again, I'm thinking about this, how it comes to mind rather than putting the debits on top, just because this is how I would think through the process. And then the other side of that transaction is really just the purchase, because they just kept it on at the purchase. So in practice, what you probably do is look at the original purchase journal entry and use that as your adjusting entry. So in here, I have to know what the purchase item is. So because the purchase, the other side would be on equity for company S. Now, when it was the first year of operations, we were able to kind of work into the equity section and see what that is. But now the prior year's net income has rolled into the retained earnings, and so we can't break it out as easily there. We kind of can. We could still kind of work it out in that if the common stock hadn't changed at that point in time, we could say, all right, well, the common stock it is what it is at the same point in time when the purchase took place. So I could then say, all right, well, I know the common stock has to go off the books. So we could say common stock is going to go off the books. It's a credit here of the 192. It's 100% owned by P. So I can say that's got to go off the books. The 192 is going to go off the books. And then you could say, all right, well, then the other side must have been retained earnings at that point in time. It's not going to be the retained earnings now, but it's the retained earnings at the point in time of the purchase, and that's going to be the plug. You can think of that as the plug. So I could say then retained earnings is going to be the plug. So I'm going to say that, and the negative sum, the plug formula, to make the debits equal the credits. So now the credits equal the debits is going to be that at the 302. So like a book problem could force you to do that calculation. Now you probably know in practice, you'd say, okay, I know what the purchase was at that point in time. I know how many shares were purchased in the par value. So I know that we purchased 96,000 shares, which is given here, times $2, the $2 par. That's going to be the 192. So there's the 192, which again, you could use to back in then the difference being the retained earnings. So there's how you'd have it. So again, you could back into it just with the numbers that are given here. So in a book problem, they might only give you this number this way and not give you this added information. That's possible, or else they could, in practice, again, you'd actually have the transaction of you purchasing it. And then the other thing we know we need to eliminate, and I would do this separately then, in a separate journal entry, I know we need to eliminate the dividends that went from P to S. So I'd say, okay, let's get rid of the dividend income over here that represents income 2P. This represents income 2P from S. We can't have that. Income has a credit balance. So I'm going to put a debit here. That's why I did that one first. I'll put the debit on top this time. And then we're going to be crediting the dividends, which is going to be, part of the retained earnings that got taken out from S and given to P. Note again, we put the dividends here and broke them out. You may have in practice them being combined together in retained earnings then being reported at the 220,000. Then you'd have to look in the GL and say, all right, 32,000 was the dividends, and then break out the dividends in that way. We're going to show them here so you can see it clearly. This is the dividends that were distributed. So then we're going to say that needs to be eliminated because it went from one part of ourselves to another once we think about this as one company. Now let's post these out and see if it makes sense. We're going to say, all right, here's the investment. Here's the investment in S. Let's go ahead and post that out into our consolidation column here, consolidation entries column. I'm going to say that needs to be eliminated. There's the credit. That should bring it down to 0, so that looks good. Then we have the common stock, so we're going to go over to the common stock, and that needs to be removed for S. S's common stocks needs to be removed because it's all included in P. So when the consolidation took place, so the common stock, which shouldn't really change since the 100% purchase typically, then you can figure what that one is. So we had the 480. And then here's the 192 for the total, and then we removed the 192. Then we have the retained earnings at the 110. That's not going to remove all of S's amount in retained earnings, right? Because it should only remove the amount of retained earnings at the point in time that we made the consolidation, because 100% was purchased. So the retained earnings that has accumulated since that time, which is now 2 years ago, is still going to remain here. So but we can still kind of back into this number because it's part of the original purchase. So you can still figure that out. So it's not going to remove it completely, but it's going to remove the portion of the retained earnings for S as of the point in time that the consolidation took place. So here's what P has, here's S's, and then there's the total. We removed the portion that was in retained earnings for S as of the point in time of consolidation. That puts us back in balance, so we're back in balance down below. Then we're going to record the other side. That's going to be the dividend income. So here's the dividend income. Here's the dividend income down here. We're over in M16. Within M16, I'm going to say equals and scroll on up to that 32,000 and enter. That'll eliminate that. That takes it down to 0. So now this dividend income, which went from the dividend distributed by S to P, so basically it went to ourselves, if we're consolidated now, has been removed. Now we need to remove the dividends, which are coming from S that got paid to P. So there's the dividends. That's going to be the credit. We're going to be over here in cell M14 and say equals. And then we'll record that 32,000. So there it is once again. Here's P's dividends that went out to third parties. That's not an intercompany transaction. There's S's dividends that went all 100% to P. There's the total. There's us removing P's dividends and getting back to just the dividends that were removing S's dividends, getting back to just the dividends that were issued by P, the parent company, that were issued outside of just ourselves, right? Okay. And then we're going to have this elimination that we've seen in the past of the accumulated depreciation, because we're going to put the depreciable assets on the books at the book value for S at the point in time of consolidation. Now it's the second year, so we can't just use the information. We kind of had a little trick that we could do when it was the first year to kind of back into that number, which you might see on like a book problem or something. We can't really do that here, but we would know what it was at the point in time of consolidation, and we'd have to put together our depreciation schedules and reflect that, and it would be a complicated process to do because note, you've got the book depreciation, the tax depreciation, and whatnot. So, because you would need supporting schedules for these things, the land and the building and equipment and accumulated depreciation, and you probably need different schedules for the book value and the so it would be more complicated than just looking at the overarching GL account. You'd need the subsidiary accounts, but in any case, we're going to say then that's the elimination entry. So that's going to be the accumulated depreciation debit, and we're going to be crediting the building and equipment. And this was given to us in the problem. So we're going to say that number must be given to us if it's not the first year of operations. It's the first year of operations and it's not given to you in the problem. Then you could say, okay, is there some way I can figure that out given what they did give me in the problem? Right? In practice, again, we probably would know it. So we're going to say that's going to be the transaction. So we're going to say then that accumulated depreciation, going to record this out, is going to be going up. It's a contra account. It's going to go down. It's a contra account. It's going down. Total assets are going up. And then the building and machinery is going to be going down. So I'm going to say this equals the credit there. So there we have that. That puts us back in balance. Now, what happened here? Again, what we did as of the point of consolidation, like if the consolidation took place now, we would say, okay, I'm going to put this on the book as of the consolidation, as if we were one on the book value, which would be the 173 before this journal entry, right? This minus this, the building minus the accumulated depreciation. That's what we want to do. That's what we're trying to do as of the point in time 2 years ago when the consolidation actually took place. At that point in time, this accumulated depreciation number was 12,000. So what we want to do is reduce the building by the 12,000, representing the book value at the point in time that the consolidation took place, and then record the depreciation expense since that point in time. So we don't do any change to the depreciation expense because that's a full year of depreciation. We're going to assume that it's correctly a calculated full year of depreciation as of this current year. What we want to do is net out the accumulated depreciation as of the point in time that the consolidation took place. So that's going to be it. So if we go back on over here now, we got, all right, so here's our assets minus the liabilities, representing that 1,300,000, equaling the total equity section of the 1,300,000. So everything's in balance. We can then post this out. Here's going to be our income. We've eliminated the intercompany transactions, the investments, the equity that's reflected in the investment as well, and then the dividends that were going out and the dividend income that were recorded as well. So we've reversed those out. We've eliminated those entries. We've entered the consolidation entries for them.